So now we have a short little session on money. One of my favorite songs is that Pink Floyd song called Money, where in the lyrics they run through all these various functions of money. Money does serve three functions. Your textbook identifies them. First of all, you have the store of wealth, the measure of value, and, well, look up the third one yourself. But these three functions all have to be met for something to be called money. Even in World War II, in various places, cigarettes served all the functions of money. They were exchangeable for goods and services, they were a measure of wealth, and they served as a store of value. And they also would measure value, say, that's a 1 pack of cigarettes night out. Especially if the gal was good looking. So those are the functions of money. They're very important. Banks can create money through what is called depository multiplication, and your book gives you a method of determining the money multiplier, which basically depends on the size of the required reserve that the bank has to have. For example, let's say the reserve requirement is 10%. If you deposit $100 into your bank, that bank only has to keep 10% of that, or $10, in their bank, available as cash. The other $90 they can loan out to the next guy in line so he can go buy that new video camera that he's been wanting. Well, then he buys the video camera and pays $90, and the person who sold him the video camera deposits that $90 in the bank. The bank keeps 10% of that, or $9, and can lend out $81, and that keeps going and going and going. So the money multiplier represents the theoretical maximum creation of money available to the economy based on deposits held by the bank. Money multiplier of 10 results from a 10% reserve requirement. Money multiplier of 20 is from a 5% reserve requirement, or 1 divided by 0.05. One of my friends, the banker, told me a while back that the effective money multiplier today is basically infinite because the reserve requirement is essentially 0. That could be one of the problems that our economy has faced. Money was just created too fast, and trying to pull back then creates a shock. Okay. The Federal Reserve System is the top bank. They have many functions. They clear all the checks for all the banks and transport the checks around. They serve as a depository for banks' reserves, for your commercial banks' reserves. They serve as the lender of last resort, and we've seen that in great form over the past several months as our financial crisis has worked itself through. The Fed has 4 ways to adjust the money supply, either increase money supply or lower it, and your book gives you what happens to the overall economy. You know, if I create too much money, interest rate goes down. Money gets too cheap, or gets less expensive to borrow, and in some cases it is too cheap. So we have a lot of speculative kind of investments. Hence we have things like the housing boom and then the bust, because it got too easy to get financing to build houses and then to buy houses. But as things adjusted back to reality, everything sort of collapsed. And that's the fundamental cause of our crisis. So 4 ways to adjust the money supply. 1, they can mess with the reserve requirement. They can force banks to hold more cash, a larger percentage of their deposits, and that will contract the money multiplier portion of the money supply. That's a pretty heavy-handed way to do it, because all of those extra loans, the banks have to somehow meet the reserve requirement. If they're loaned out to the max, they will in fact have to call in a bunch of loans, which could cause some trouble for their customers. They can adjust the interest rate by stating, we're going to charge so much money for you banks to borrow money from us if you need to borrow money. And that discount rate establishes then the federal funds rate, which establishes then the prime rate which is sort of the baseline for commercial lending in our country. They also do, their main function is through what's called open market operations. That's where the Federal Reserve System will buy and sell U.S. Treasury bonds, notes and bills on the market in order to either pull money off the market when they sell a bond or to put money back on the market when they buy a bond back from a bond holder. Now, that's big time business here for the Fed, and that's their primary tool for managing the overall money supply. Well, there's a fourth blank one, and that's the Zimbabwe solution, the Serbian solution, the German solution back in the 1920s. They could, in fact, just print money. But printing money, of course, leads directly to inflation. Just a quick snapshot of money, and remember, the more you have, the more you need. So being a pauper is sometimes not so bad.